Hello friends, welcome to learning sessions. So we'll be discussing it in detail, so kindly do watch this video till end. And further, if you have not liked this video so far, do like the video and share this video among your friends and colleagues who have been preparing for JAIIB CAIIB 2023. And let me tell you that updated syllabus videos, the chapter-wise questions, mock test, mega mock test, and the complimentary access to the ePDF notes is now available with learning sessions. Do enroll right now. Visit the link iibf.info, or you can download our Android application which is available in the name of IIBF Learning Center. And if you're iOS user, do download my institute application and use the organization code JAIIB so as to enroll to the courses, and do not forget to use the coupon code exams over there so as to get the flat 82% off on all the courses over there. This video is related to factoring, forfeiting and trade receivable discounting, that is trades over there. Now what is actually factoring? Factoring is actually a type of a finance facility which is actually provided by a factor company to the creditor of the creditor over there so as to assign their book debts. Now let me just explain to you with an example. Let's say the case that here we are having a corporate XYZ, and it has actually sold the goods and has rendered the services to the different clients, let's say A, B, C and D over there, and these are the credit transactions. Okay, now these are the credit transactions that they have not paid the cash yet, and further it will be available in the books of XYZ as account receivables. Now account receivables is actually an amount which is yet to be received by XYZ, and for the XYZ, let's say it's in a tight liquidity condition and it actually requires funds with it, but right now the amount is due, and let's say they will be XYZ will be receiving the amount after a period of 3 months. So credit is given actually for a period of 3 months. Okay, now here actually XYZ will be assigning these account receivables, so a charge of assignment will be processed, and further these account receivables will be transferred to the company that is a factor over here. That is a factor over here. Factor will be purchasing these account receivables, and further after a discount and after maintaining a margin, it will be paying the liquidity to the XYZ. Let's take the case the amount due was rupees 10 lakh and it paid amount of rupees 7 lakh to the XYZ. Margin of 20% was taken, and further it paid the 7 lakh after deducting its fees and all the things over there. And further on the due date after the 3 months, it will be collecting the account receivables from these particular debtors over there, and that will be the case. Now by doing this, the credit sale of XYZ was basically converted into the cash sale, and moreover there was no hassle as such so as to maintain the book debt, so as to maintain the account receivables, so as to collect the monies on the due date. So there was no harassment with the XYZ now on. Okay, so that's actually related to factoring over here. Now what are the features of factoring? So factoring is actually an arrangement for financing a company's business against the invoices raised to its buyers over there. Now factor is actually responsible for what? Factor is responsible for the credit control, so he is managing the credit over there. He is going to manage the sales ledger over there. He is going to administer those credits over there, and also he is going to do the collection activities at his own part over there. So that are the things are now available. And further in India, the factoring is actually regulated by the Factoring Regulation Act 2011 over here. Okay, so I've already told you the idea related to it. Now just go through that particular picture over here and it will basically clear your data more. Now here we are having the client who has actually made the credit sale of the goods to the customers over there. So the customer is actually a debtor over here who is yet to pay the amount, and client is the creditor over here. And further, because he has paid the amount on credit, there must be the account receivables or the trade debtors over there, and further these account receivables will now be assigned to the factor over here. Let's take the case that the factor will be paying after margin contribution 80% of the monies to the client over there, and will be managing these credits over there, and on the due date it will be basically collecting the amounts from the customer over there. So that's actually related to the factoring. Now let's understand the types of factoring. Now let's understand the part related to the types of factoring over there. So first of all, it's related to the recourse factoring. Now recourse factoring is actually related to the funda. Let's take the case that the amount was due on A after 3 months, and factor basically asked the person A so as to pay the amount, but person A over here defaulted. Person A made a default over here. Now under the recourse factoring, factor will be having a right so as to recover the amount dues against the defaulted amount from the client itself. So that's actually related to what? That's actually related to the recourse factoring. And where there is no right with the factor so as to recover the amount from the client itself, whether there is default or not, that is a non-recourse factoring. So that's actually related to non-recourse factoring. Other than that type, we are having the two types. We are having the domestic factoring and the international factoring. Now when the debtors and the creditors all are present in a one territory, all are present in the same country, that's actually related to what? That's actually related to domestic factoring over there. Now receivables which are assigned to the factor are only the inland receivables, are only the domestic receivables over there. And for the factor makes an upfront payment of 80% after basically deducting the margin and the discount charges to the client over there, and the rest amount will be paid after the amount is settled. Okay, so that's the case related to it. And further, in case of international factoring, the purchasing of the invoices, the purchase of invoices from the client is actually for the customers who may be in the other countries. Okay, let's take the case that we are having a client that is a corporate who has made the credit sales to the person A and B over here, who are actually in USA and not in India. Now the invoices has been drawn, and now these are the basically representing the book debts over here in the books of a client. And further, the client visited the factor over here. Now factor will be assigned this book debts, and further he'll be collecting the monies. Now in that particular case, it can be the case that there can be a export factor also. Now there can be a export factor also, and further there will be an import factor also. So there will be two factors in case of the international factoring. So it may be the case that in case of international factoring, there may be two factors involved. One will be in the domestic country, over there, and one will be in the abroad. Okay, so that's actually related to two factors, so that they can be coordinating with each other. So whensoever the books are to be assigned to the domestic factor over here, the factor will be sending an indication to the abroad factor, to the other factor in the other country over there, where the customers are situated, where the customers are actually residing over here. And further, the other factor will be confirming the criteria related to the same, whether those can be actually be covered or not. That will be covered, and further same will be intimated. Only then the amount will be paid to the client over here. And when it goes to recovery, the factor in the other country will be recovering the amounts from the customers over here, and further the same must be given after deducting the fees to the domestic factor over here. So that's the case related to the international factoring. Okay, so international factoring, there are usually two factors. One, it is the export factor, and the other one, it is the import factor in that particular case. Now let's understand this through this particular picture over here. Okay, now we are having an exporter who has actually exported the goods to an importer over here and to an importer over here. That's the case related to it, and they must be having a sale agreement between these two. Okay, and further, the exporter has given a credit to the importer over there. Now exporter will be actually going to the exporter factor over there, and it will be assigning the invoice to this particular export factor over here. Now after that, export factor will be sending the invoice data. As I told you, the data will be sent to the import factor over there, and import factor then we basically processing the assuring the risk associated with the importer over here, and after that it will be conveying the same. And further, after that, the exporter factor will be providing the anticipated invoice collection along with it will be settled into the exporter's account, and on the due date, the amount will be collected by the import factor from the importer, and further confirmation related to the funds will be sent to the export factors, and that there is a process basically comes to an end. Okay, so that's the case related to it. So first of all, agreement, and after that the invoices are to be assigned. After that, it will be intimating the import factor. The factor will be importing the import factor. Import factor will be looking into the risks associated with the importer over there, and same will be conveyed to the export factor. Export factor will be giving the finance to the exporter over there, and further on the due date, the import factor will be collecting the funds, and further after that, the funds will be sent to the export factor over there, and that basically is related to the international factoring over here. Now let's understand the types of international factoring over there. Now it may be the case that there is a single factor system, that there will be only the import factor comes into account, but only if the buyer defaults in making the payment over there. Okay, other than that, there will be only the export factor that will be over there. Okay, so import factor only will be come into picture over there only if there is a default made by the importer over there. And further, it's it's related to the direct export factoring system. Now in the case of direct export factoring system, there will be only one factor, that is the export factor, that will be managing all the aspects related to the factoring transaction over there in case of international factoring over there. And the other one, it's related to direct import factoring system, that is there is only one factor, that is the import factor, which will be managing, which will be directly dealing with the client over there and will be managing all the aspects of the transaction over there. Okay, so that's actually related to it. Now let's understand the bill discounting and factoring. Now what's the difference between them? Now bill discounting is actually related to what? Let's say the case that the bill has been generated. Let's say the case an export bill has been generated by the exporter over there. Now this bill is actually accepted by the importer over there, and for the exporter will now bring that particular bill to the bank over here. Bank will be discounting that particular bill, that is discounting, and I have already conveyed the idea related to the factoring to you. Okay, now let's understand the differences between these two. Now actually bill discounting involves financing only. Now based upon the bill, there will be financing related to the same, that's actually related to bill discounting. But in case of factoring, it basically involves a total package, because there will be administration of the credits, there will be control of the sales over there, sales ledger over there, and moreover in case the collection is also by the factoring over there. And I told you that it's available in both the versions, that is with recourse and without recourse. Bill discounting includes only those trade debts which are supported by the account receivables, not more than that. Or like in case the bill of exchange is drawn, only those are covered, other than that no one is covered. And further, factoring includes entire trade debts of a client. It includes entire trade debts of a client. And further, it is an advance against bills. So bill discounting is what? So bill is already drawn, and further it's an advance against those bills. Okay, but in case of factoring, it is actually purchase of the trade debts of a client over there. In that particular case, it's not an advance, it's basically purchasing, it's basically related to purchasing the trade debts of the client over there. And further, in basically the bill discounting, individual transaction oriented process over there. It's an individual transaction oriented process, that for a single importer, the export bill that you have drawn, you'll basically get it discounted over there. So that's a single transaction oriented. And further, in case of factoring, it's a lump sum finance against a set of invoices. Now it may be the case that there are 10 invoices, and it may be the case there are 20 invoices and even more. Okay, so that's actually related to it. And bill discount is only available with recourse, whereas the factoring is available in both the versions, that is with recourse and without recourse. Now let's have a look at the advantages of the factoring. I have already told you that factoring basically replaces the high cost market credit. You need not to go for high cost market credit over there, and it is an instant finance that is available, and lower margin of up to 20% is to be maintained by the factor, and the rest of the amount after deducting the discounting the debts is basically given, credit is given to the client over there. And further, the MIS reports and sales ledger administration is totally taken care by the factor over there, and factor actually receivables turnover and basically improves the operating cycle. And actually the factoring converts the credit sale into the cash sale over there. So these are the advantages of the factoring over here. After that, it's related to forfeiting. Now forfeiting is actually a type of finance that actually helps the exporter. Now when we are talking about the forfeiting, it's actually working in the international market only. Like I told you, in case of factoring, the bills receivables, the account receivables, the trade debts, those can actually be covered under the domestic trade debts, and can also be covered. But in case of forfeiting, we are covering only the international exports only. Okay, so that's the case related to it. Okay, and further, what's of the exports receivables, you can get them encashed by encashing through the forfeiter over there. Now let's understand the mechanism of a forfeiting transaction. Now in India, Exim Bank actually conducts the forfeiting transactions for the exporters community over there, and let's understand the steps which are involved in forfeiting the transactions over there. So exporter will be negotiating the tentative contract with the importer. Now we are having the exporter, and further we are having the importer. Exporter will particularly be saying that what credit period will be given to the importer over there, and they will be having a tentative contract with the importer over there. And further, after that, exporter will be approaching the Exim Bank over there, and they will be obtaining an indicative quote that for this particular quote, what would be the forfeiting cost? What would be the forfeiting cost for this particular transaction over there? So Exim Bank will be contacting the international forfeiter. It will be contacting the international forfeiter that's actually residing in the country of the importer over there, and further it basically gets an indicative court for the same, and for the based upon this indicative court, the court will be given to the exporter over there, and further if accepted, in that particular case, after deducting the forfeiting fees and after basically discounting the bills, the amount will be remitted to the exporter over here. That's actually the case related to it. Okay, and once the goods have been basically exported, after that only the amount will be paid by the Exim Bank to the exporter over here. Okay, so that's particularly the case related to it, and let's understand the fees which is involved in forfeiting. First of all, it's related to discount fees. Now, discount fees is related to what? It's basically the interest cost. Let's say the case that the credit period was for 3 months. Now, for this particular case, whatsoever the credit period was, for that particular case, whatsoever the interest was to be charged, that will be deducted as a discounting of the discounting over the trade debts over there, and further that will be deducted, and that's related to discount fees. So, discount is normally linked to international benchmark rate like LIBOR over there, and then the second fees, it's related to commitment fees. Now, commitment fees is actually payable to the forfeiting agency. It will be payable to the forfeiting agency over here. So, as for commitment to execute a specific forfeiting transaction at a firm discount rate with a specified time. So, it's particularly a fees, that's a commitment fees that will be paid to a forfeiting agencies over there. Like it will be paid to the Exim Bank, and for the Exim Bank will be paying some part to the international forfeiting agency over there. So, as to basically execute their commitment in that particular forfeiting transaction over there. So, these two fees are involved in case of forfeiting over there. Now, let's understand the advantages of forfeiting. Now, forfeiting actually provides 100% of the finance without recourse. Now, forfeiting is available only and only in without recourse version, and forfeiting actually improves the cash flow for the exporter, because exporter can be converting the receivables into the current inflow over there, and further it's related to it basically saves the administration cost of the exporter over there. Exporter is not to check that after 3 months he will be asking the importer so as to pay the amount and something like that, and moreover it will be increasing the liquidity with the exporter over there, so that the trade opportunities also increased, and further forfeiting enables the exporter so as to avoid the various risks, like it could be in the case of the deferred payment, it will be related to the country risk or interest rate risk or currency risk. These risks can be there which are actually avoided. Okay, so that's the case related to it. Now, let's basically differentiate the two, that's related to factoring and forfeiting. Now, if you look at the trade, now factoring is for domestic as well as for international transactions, whereas forfeiting is just for international transactions. If you look at the time period, the factoring is for short term duration, but forfeiting is actually for the medium to long term duration, like for 1 to 5 years. And further, if you look at the recourse, the factoring can be with recourse and without recourse, whereas the forfeiting can only be without recourse generally. And if you look at the financing is basically up to 80%, that is 20% is the margin. But in case of forfeiting, it is basically 100% finance can be given to the exporter after deducting the discounting fee and the commitment fee. And further, if we look at the goods generally associated with the trade receivables on consumer goods, whereas in case of forfeiting, it's generally associated with the capital goods, because in case of the exports over there, we are just generally basically go for the capital goods only, okay, for which the forfeiting services are available. If you look at the charges include the financing, collection, administration, and the credit protection and MIS charges over there. And further, in case of forfeiting, it involves discount and the commitment charges over there. Okay, so that's actually related. And after that, it's related to trades, that is trade receivables discounting system. Now, actually, Reserve Bank of India in 2014 launched the trade system so as to address the credit challenges which were faced by the MSME sector in India over there. Now, what were those credit challenges? Because the receivables were not basically promptly available to the MSME sector over there. That basically led to what? That lowering the liquidity with the MSMEs so as to process their working operating cycles over there. And the trades was an electronic platform so as to facilitating the financing and discounting of the trade receivables of MSMEs. Now, whatsoever the trade receivables of MSMEs, MSMEs, those can be financed and those can be discounted using the electronic platform of trades over there through multiple financiers. So there will be multiple financiers in that particular system. And if we look at the participants under the trades, so we are having the MSME suppliers, we are having the buyers, and we are having the financiers. So basically that's related to trades. So it's particularly related to trade receivables discounting systems. Now let's take the case that we are having the MSME producers, suppliers who are basically supplying the goods, MSME goods over there, and further buyers will be buying the goods, and further will be having the financiers who will be financing these transactions. Now whatsoever the trade bills which will be drawn by the MSMEs over the buyers over there, accepted by the buyers over there, those can now be discounted and those can be financed by these financiers over there. So that's actually related to it. And after that, it's related to eligibility criteria. Now, there are two types of criteria over there. First of all, it's related to financial criteria, and then it's related to technological capability. So first of all, it's related to what? It's related to entities minimum paid up equity capital. Entities minimum paid up equity capital must be 25 crore rupees, and the foreign shareholding in trades would be as per the exchange FDI policy or foreign investment policy only. Okay, and if you look at the technological capability in that particular regard, it shall be able to provide the electronic platform. So trades must be able to provide the electronic platform to all of its participants over there, and further related information related to the bills, related to invoices, related to discounting of the course, that must be disseminated, that must be available in a real-time basis to all the participants over there, and there must be online surveillance capability within the system over there so as to check the system manipulation if there is any. Okay, so that is actually related to trades over here. I hope that you must have learned the concepts related to the same, and that was all related to this particular video. Kindly please do rate this video out of 10, and don't forget to like this video and share this video among your friends and colleagues who have been preparing for JAIIB 2023, and do enroll the courses visiting the website iibf.info, where you will be getting the access to the full course videos, chapter wise questions, mock test, mega mock test, and the complimentary access to the ePDF notes. And don't forget to use the coupon code exams over here so as to get flat 82% off on all the listed courses. So that will be all. Thank you so much, and see you again in the next video.